My name is Rob Wessel and I'm managing partner of Hamilton ETFs. Today, we're going to talk about the Canadian banks. In particular, we're going to talk about the fact that the Canadian banks have had a negative 2-year return for the period ending October of 2023 of more than 10%. We are going to identify and discuss 3 aspects. Number 1, we're going to talk about just how rare this has been over the past 20 plus years. Number 2, we're going to talk about what this has meant for investors in the past when it's happened and what it could mean to Canadian bank investors today. And third, we're going to talk about investing solutions. Our firm offers 3 Canadian bank ETFs that are very popular, and we're going to talk about how they might fit into your portfolio. So let's talk about just how rare it is for the Canadian banks to experience a negative 2-year return. The following chart shows rolling 2-year returns since the inception of the Canadian Bank Index over 20 plus years ago. As you can see, the first thing that jumps out at you is that the Canadian banks have a positive 2-year return the vast majority of the time. In fact, out of the 222 month-end periods, there are only 26 periods where the Canadian banks had a negative 2-year return, and those are highlighted in red. The second thing that you see that becomes clear is that the periods in red are clustered around 3 different time periods. First, the global financial crisis, of which there are 14 months end where the Canadian banks had a negative 2-year return. The second is COVID, where there are 8 month ends. And the third period is our current period, of which there are 4. The other thing that we would point out is that there have also been, over this period, quite a few significant negative events of which the Canadian banks still managed to report a positive 2-year return. And those include the European sovereign debt crisis, 2011-2012, Brexit in 2016, and the yield curve inversion in 2018. So let's take a closer look at these negative 2-year returns. So let's now talk about what it has meant in the past for Canadian bank investors and what it could mean to Canadian bank investors today by reviewing the following table, which shows how the banks performed in the following 12 months after each negative 2-year period. So, what are the key takeaways from reviewing this table? First, of the 22 periods, the Canadian banks had a negative 1-year return in the 12 months following just once, and that was near the beginning of the global financial crisis. Takeaway number 2, that means that 21 other times, or 95% of the time, the Canadian banks had a positive return in the following 12 months. Takeaway number 3, not surprisingly, the more severe the correction, the more powerful the recovery. And takeaway number 4, maybe the most important one, is despite all of the different circumstances and all of the variation of all of the 21 recoveries, the lowest return was still over 13%. So with that being said, let's talk about valuations and how the Canadian banks might perform in the upcoming Q4. So the Canadian banks are pricing in a lot of bad news. They currently trade at about 9.0 times forward earnings according to Bloomberg. So that's a pretty steep discount. So what does that mean? In a more normal environment where, say, GDP growth or nominal GDP growth was about 2%, macro risk, including inflation, was benign, they'd probably trade at around 10.5 times forward. And in fact, they've traded at much higher than that in the past, but let's use 10.5 times as a reference. So that means that the Canadian banks would have to rise about 15% to get back to more normal PE multiples, and that's excluding the impact of earnings growth. So for more information about our views coming into Q4 and for next year, we'd refer you to our insight that we posted on our website in our YouTube video, where we talk about how Q4 could be a cleanup quarter. We identify ways in which the Canadian banks might clean up their results and set the stage for an improved 2024. In terms of gaining exposure to the sector, we're the number 2 provider of Canadian bank ETFs, and we offer 3 ETFs. The first is the Hamilton Enhanced Canadian Bank ETF, which trades under the ticker HCAL and has assets under management of over $400 million. We also offer a more generic low-cost solution, the Hamilton Canadian Bank Equal Weight Index ETF, which trades under the ticker HEB. And then third, we have a unique strategy which adopts mean reversion. It's the Hamilton Canadian Bank Mean Reversion Index ETF. And what that ETF does is it overweights the 3 Canadian banks that are oversold, and it underweights the 3 Canadian banks that are overbought. So for more information about Hamilton ETFs and our funds, please go to www.hamiltonetfs.com. Thank you.